Meet Helen Astle. She knows better than most that the majority of ecom brands just aren't profitable.
A lot of brands I see really kind of stagnate as these budgets are set, but they're not implementing the process.
From living the corporate dream to working for a number of major brands like Innocent Smoothies, she then decided to go out on her own, founding fractional CFO company, the CP Stack.
I think the business owner has to sit in that CEO role. And as a result, they should be the one that are organizing and leading the discussions.
And their mission? To help brands unlock profitability, implement major cash flow improvements, and stay financially afloat.
So it's really important you know and understand all aspects of what gets you to net revenue.
In today's episode, we'll be taking a closer look at how she does it, the ways brands can improve their financial management.
It's hard for them to make a profit. So if you don't have some of these foundational elements in place, you're really not going to be able to scale.
And why for founders, this should be the number one item on their to-do list.
And I think the more successful founders are the ones that figure out what they're good at and figure out what things that they need some help with.
Hey guys, welcome back to another episode of the podcast. And this week I'm delighted to be joined by Helen, and she is one of the co-founders of CP Stack. So getting straight into it, these guys are a fractional CFO company. And today we're going to talk about, how you can implement what they do with your ecom brand. And I want to start by talking about the intersection of finance and marketing, because I think this is a point that's been ignored for many years. And I want to start by asking you, Helen, how can finance teams collaborate more effectively with agencies that, the brands are working with?
Yeah, thanks, Jordan. That's a great question. And actually, I completely agree with you. This is an area that has been, particularly for smaller companies, really neglected for years. I see teams many times just operating in silos. So the founder will bring in their finance team, their marketing agency, their email agency like yourself, and these teams won't be talking to each other because they're outsourced. And I see a huge opportunity there for more collaboration. So whether it's a monthly meeting or a fortnightly meeting, or hopping on a call, just making sure that everyone really truly understands the plan, that everyone's got a really clear shared set of goals as well, is super important. So yeah, so I think just everyone can just getting around the table around a clear set of goals and making sure that we're operating to the same numbers. I see agencies working to different revenue numbers to finance. You're smiling because you know that happens all the time. Understanding what a company's overhead costs are and what you need to do to get ahead of them. And then the big one for me is I often see agencies who are perhaps like limited by a finance budget. They'll be like, hey, we can spend 50K a month. And there's no mechanic for discussing and increasing that. So say, for example, your customer acquisition costs are lower than planned and you're able to scale. But there isn't a process for having that conversation, approving those increased budgets, understanding the impact on inventory and working capital, and then just being able to put your foot on the gas. And so a lot of brands I see really kind of stagnate as these budgets are set, but they're not implementing the process for adapting them and helping the company grow revenue.
Okay. And in terms of these conversations, what do they look like? Are they kind of three-way and including, business owner as well? And who kind of leads those discussions?
Yeah, I think the business owner has to sit in that CEO role. And as a result, they should be the one that are organizing and leading the discussions. Often the founders, particularly at sort of smaller end of the business scale, say 1 to 5 million in revenue, perhaps don't have that experience. They're often a product led founder with a product background that is now finding themselves in a CEO seat and running a business. And so I think it's up to us as sort of the agencies and partners to lead them to that place where perhaps we're slowly transitioning to the stage where they're leading the meeting, but at the start, actually just getting everyone around the table is just really the key kind of first step. And that could be a monthly meeting at the outset, and then perhaps move to weekly or fortnightly. And we actually have a special kind of financial reporting tool that we use. You can import non-financial KPIs into that. So having everyone lined up around one set of numbers, I always call it like the single source of truth, so that everyone can make decisions on a timely basis.
Okay. And you mentioned there kind of KPIs and metrics. What are the kind of key KPIs that you want to be tracking and you think kind of, brands and agencies should be looking at to kind of find that North Star of truth or whatever yeah.
Yeah, I mean, we have a set sort of with my CFO hat on. We have your classic kind of finance KPIs, but I think they're important that actually everyone in the team at a senior level understands them. So revenue, gross margin is critical, and then your EBITDA, which is your earnings before interest, tax, depreciation, and amortization. So making sure those three numbers are widely understood, and understood what goes into those numbers as well is important. And then we also tend to report on the classic, if it's an ecom business, ecom KPIs such as traffic, conversion, average order value. And then contribution margin for brands is probably, if I had to pick just one KPI to have, it would be the company's contribution margin. Because otherwise you don't have a good understanding of that. You just don't know whether you can scale.
Okay. And then I think, next question is in terms of discounting. I know this is, something that a lot of people in the finance space kind of have a strong opinion on. What do you think on price discounts versus marketing discounts and the kind of overall topic?
I think it's important to define them for a start. I mean, I think you and I, Jordan, previously have talked about the definition of revenue, which is one thing between team finance and team marketing, is definitely one area of the business that people just aren't on the same page as. Just like for the purpose of this podcast to run through that, I take a company's MSRP or RRP, depending on what country you're in and where sales tax is at, as your gross revenue. You would then take any pricing discounts off that to get gross revenue, which is actually what Shopify reports. So Shopify will report your gross revenue. And it's important to, I think a lot of companies miss that gross revenue is net of pricing discounts. And so when we're talking about discounting, which is what you brought up, you correctly identify there's two types. There's the pricing discount, and then there's the promo or marketing discount. So for companies on the Shopify platform, the discounts line then is then anything that's taken off below that pricing discount, and then returns are taken out to getting to net revenue. So it's really important you know and understand all aspects of what gets you to net revenue, because I see companies losing 40-50% from what out the gate from what their original price of their product is. And that's a huge amount that consumer goods businesses that will typically, even at scale, only operate on a 10 to 15% net profit. There just isn't room to lose margin and room to make mistakes right at the top of your P&L and have to be scrambling around at the bottom to then catch up. I think discounting is absolutely necessary to clear inventory, because particularly when you're scaling, you're going to make mistakes about what products you buy. And you have to go through that learning cycle as quickly as possible to be able to scale your business. Again, I think a common trait I see in founders is getting quite attached to products, and they think at some point in the future it's going to start selling. And sometimes that's true, but that's where that relationship needs to come in with a marketing agency, where you're identifying those slower moving products, and maybe you need some new creative that will actually move the dial there. But otherwise, I think you need to be using price discount to ensure that you're turning through inventory and getting cash back into the business so you can continue testing and continue growing that business.
Okay. Can you just quickly, before we go dive into some of what you said there, can you just define the difference between price and marketing discounts?
Yeah, so price discount, say for example, I'm a t-shirt company, really expensive t-shirt company, and I sell it for $100 is the MSRP or RRP, so the kind of top line price. I might put that on sale, and then I'm going to use Shopify as an example because most people are on that platform. But you would then keep $100 as the compare at price and change the price down to $80. And then depending on how your backend is set up, people would then see a 20% discount potentially on that product. So you've lost $20 out the gate right there. You'll then in your email flows, you've then got a first purchase 15% off. So now I can't actually do the maths in my head, 15% of 80, but you're now down to, I've picked tricky numbers. You're now down to say $68 or something, right? So what was $100 t-shirt is now, the consumer is now paying $68 and you just lost $32 of margin that you had to play with.
Yeah. So just picking up on something you said before that, then, is your view that the marketing discount should only be used if there's kind of a second order consequence that's beneficial to the business, like clearing excess inventory in certain SKUs?
In terms of pricing discount, I would argue that that is true. I think discounts have to just be used in a smart way and not all the time. You've really got to think about what and who your brand is. I think you've got to test your discounting strategy. Don't assume that you need to give away 15% on pop-up. Like, what does that look like at 12? What other ways can you achieve that goal? And for higher AOV brands, let's take some easy numbers just to make the maths easier. But say you've got a $300 AOV and your discount is $10, you're giving away $30 out the gate. What happens, Jordan, like if I said to you, hey, we're not going to do a discount, but I'm going to give you an extra $30 in your customer acquisition cost? Having those conversations and being certain about them is important. I do see it's the classic kind of business school chart, right? What's the price volume mix? What happens to volume when you discount to a certain extent? And the consumer is pre-prepared nowadays to want a discount. A lot of people feel like they need one. So it's definitely an area a company has to test, particularly as they scale, but also just tread really carefully, because you're smiling when I'm telling you can have an extra $30 for your customer
Yeah.
acquisition. So yeah, I think that's an interesting discussion to have.
Okay. And in terms of the two main metrics that agencies would look at, especially on the acquisition side, being CAC, so customer acquisition cost, and ROAS, how do you view those two metrics?
I think they're great as long as you define them. Too many agencies and people are confused about what the inputs, particularly to ROAS, are. So ROAS is return on ad spend and typically calculated as gross revenue divided by marketing costs. But being certain about what gross revenue is that net of returns? Is that net of discounts? Being certain about what goes into that and how each platform is reporting that is critical. And then also being really clear on what marketing spend is going into your ad spend. Is that just platform ad spend? Is it your agency fee? Is it your fixed versus variable cost? And this is my point about having everyone around the table on the same numbers and being really certain about how they're being calculated. Because there's definitely, just to add a point here, there's definitely some industry sort of standards on ROAS. Hey, we've got 5 ROAS here. This is awesome. You can scale. But what does that mean if they're selling highly discounted product at, say, a 40 or 50% margin? That ROAS doesn't mean that your business is scalable or profitable. And that's where finance needs to come in.
So I was just going to say that before you said this, like it sounds like finance should be setting these definitions rather than potentially overzealous agencies.
I think it's a conversation between the two. I think the agency can set them, but we just really need to know what's going into them and how they're being calculated. And there needs to be transparency across the team for the business to grow.
Okay, so you mentioned before about contribution margin being the most important number that you're looking at. Can you just talk through the reasoning behind that?
For typically consumer goods companies, contribution margin is just critical because it's answering the foundational question of whether or not you can scale. I see. So just to define contribution margin, it's your gross margin, which is all your revenue, less all your unit costs taken out, and then less your marketing spend. If your contribution number isn't a positive number, you're never going to be able to overcome the overheads in your business and have a business that can scale. So as you scale, your overheads growth should be slower than your contribution margin growth. But it's hard to scale, and really understanding the fundamentals of scaling, which is centered around your contribution margin and what that percentage is, and having a plan. So say your overheads are 100K a month, then you need your contribution margin to be well over 100K a month to be making a profit. And that's where sort of the timely, accurate financial reporting comes in, so that you know those numbers. And once you see that you have a business that you can scale, you're able to scale rapidly to get over and ahead of those overheads.
Okay, and are there certain benchmarks, I guess, or is it looking at peer groups? Like, how do you know what's good and what's not?
Yeah, and I think that's where someone like myself, and there's other companies and teams out there that see multiple brands, multiple businesses. I've been involved in consumer products for over 20 years now, and so have a pretty good idea of what those margins should look like. For example, like most consumer goods, direct to consumer goods brands need to be operating at least a 70% product margin for there even to be enough room in the P&L for them to scale. If you look at, for example, a Lululemon, who's operating at sort of around a 10 to 15% net profit, so $10 billion companies, they're now operating at scale. It's hard for them to make a profit. So if you don't have some of these foundational elements in place, you're really not going to be able to scale, or at least a path to get there. So I get that smaller companies will often have fairly low minimum order quantity. Their product margin may not be 70%. But I think that the founder needs to understand that at scale, at say 1,000 units, how do they get there and can they get there? Because there needs to be a path to profitability at some stage.
You've mentioned a few times kind of, timely monthly reporting being, super critical. Why is that? And, I'll certainly say like a lot of the businesses we work with, that's not the case. So yeah, why should founders be taking it more seriously?
I think that's just kind of become my mantra because I see so many people not getting that service from their accountants and bookkeepers. And it's okay to ask for that. You should be demanding that and you should be asking for that. So we deliver our financial reporting typically anywhere between business day 10 and 20, kind of depending on the company's requirements, their stage of growth, their funding, etc. And often I'm giving founders a heads up as to what's happening pretty much straight out the gate month end. Hey, you've done this much in revenue. Do you know what? I think you can be profitable this month. And yeah, good job. So, and then I talk about accuracy as well. So that's the kind of timeliness of it. And that's really important to enable the founders to make, and the CEOs to make decisions. If they don't have their numbers, they don't know what's happening in their business in a timely manner, they can be running just blind for months with their overheads perhaps spiraling out of control. Their business at that stage is leading them, not them leading and driving their business forward and making decisions as and when they need to. Having timely numbers, a P&L, balance sheet, and cash flow is just a non-negotiable for me. And the accuracy piece is another area I feel like is a huge opportunity for companies. Many businesses will report on a cash basis and not on what's called an accruals basis. So just to give you a little example of that, if, for example, you might pay a big rent deposit in a month of, say, 10K, well, that shouldn't be recognized in your profit. So if a company could come along and say, oh, no, I made a terrible loss this month, but because that rent deposit hasn't been recognized correctly, which is actually is an asset for your business. So it's impacted your cash flow because you've had to pay 10K out, but it's not impacting the fundamental profitability of your business. So that's an example of accruals-based accounting. And again, that's a non-negotiable for me. And in consumer goods businesses, areas that I see constantly going wrong are things like gift cards, which actually are a liability. Like you've got to ship those goods out in the future, and they need to be recognized as such. And many accounting and bookkeeping companies don't do so. And also reconciling the receivable from credit cards at month end. A lot of companies, because you can actually edit Shopify data, and I see this sometimes, like orders will get canceled or changed. You need to make sure that your revenue and your cash that's coming down the line is actually accurate. So I've seen a number of businesses overstating revenue where they've kind of automated these transactions and then come seriously unstuck later and having paid too much sales tax too.
I want to talk more about kind of, this cash flow impact and, how we're recognizing things. And I think, working capital is key here. So first off, can we just kind of define what it is, and then, why it's such a big deal and so important to look at as we start to grow?
Well, the definition sort of in accounting speak is your working capital is your assets minus your liabilities. Applied to consumer goods companies, typically the biggest balances tend to be your inventory and then your accounts payable. So what you owe people. So, and the next point to make is that most consumer goods businesses have a negative working capital cycle. So you look at the classic model where you're placing an order for goods in China, perhaps like 6 months in advance. 2 months later, they've made the product, but because you're a small company and don't have great credit, you're having to pay for that prior to shipping. In our case, because I'm over in Canada, it then gets on a boat for 6 weeks and then has maybe another 4 weeks to a distribution center. So you just paid cash out, probably 2 to 3 months prior to even being in your DC and being able to sell it. So this is what I mean by negative working capital. And it's incredibly hard to scale these businesses. And I think a lot of founders at the outset don't perhaps appreciate the working capital needs of their business when it comes to scaling. And I think this is where that hookup between finance and marketing agencies is critical, because the marketing agencies are like, hey, we can put our foot on the gas. And finance like, hang on a sec, that means we need another 100K or 200K, and I've got to go to the bank to get that, or some other source of finance.
Okay. And yeah, I guess kind of picking up on that, what can businesses or brand owners do to mitigate some of this, negative working capital cycle?
Negotiate terms with suppliers. Just pushing your suppliers and saying, hey, I need 30 days terms, and reviewing those terms regularly as well, trying to negotiate pricing discounts, payment terms out the gate as well, and pre-orders from your customers. It's tricky when it comes to kind of sampling and photography, but the pre-order plan can at least get some cash in the door to mitigate some of that working capital issues. It's tough though. This is probably the hardest area in the single reason I see businesses fail and struggle is understanding and getting ahead of that working capital and understanding the impact on the business.
Yeah, I was going to say, like, this capital crunch is the most common reason why these kind of type of brands go bankrupt, right?
Exactly, because you can be profitable but out of cash. And particularly when you're scaling those brands that are scaling kind of double-digit growth, well, they've also need to have double-digit growth
Yeah.
in their working capital as well, unless they can rapidly improve their payment terms. And
Could you
that
just
finance is really hard to get.
could you just maybe walk us through an example of, how, some of this rapid revenue growth impacts inventory and working capital needs?
Okay, so let's do an example, say a business that is doing 1 million in revenue in year one and 2 million in revenue in year two, right? Well, let's assume that they're a pretty bog standard consumer goods company and COGS is 30%. So COGS, cost of goods. So in year one, you'd need to buy 300K of inventory and year two, 600K. A lot of brands I see hold probably above industry standards at scale, that is, of inventory. So bigger companies will probably hold 3 to 4 months of inventory, but the smaller businesses I see often are holding a 6 to 12 months of inventory. So in this worked example we're just doing, in year one, they'd hold 150K of inventory. In year two, you'd hold 300K. So in between year one and year two, you need an additional 150K in cash to grow your business from $1 million in revenue to 2 million. And the big issue here is that most banks will only lend 10 to 15% of revenue. So the amount that traditional banks will lend, even if you have good personal credit, and that would often come with a personal guarantee as well. So you're taking all the risk yourself. Maybe they get a lien on your house. They won't even lend you enough money for you to grow your business at that scale. And that's where either I see brands taking revenue financing like Shopify Capital, which is extremely expensive, or going to investors to
Well,
support that growth.
talking on that, then, can we just walk through the kind of different ways that people can plug the gap and the different kind of investment opportunities that they can look at?
Yeah, it depends what stage your business is at. So there's kind of that early stage survival. Like you've got some products, you don't really know if they can sell. You don't, Jordan, you're smiling. You don't really know whether you've got a scalable business there and a product market fit. And that early stage, the financing typically comes from the founder themselves, sometimes from credit cards, friends and family that really believe in them as a human being to enable them to scale. Beyond that, you can start to access, actually the other key one at that stage is looking at grant funding, which varies from country to country. And it's really important to see how you can access those either cheaper loans, non-dilutive capital, which is debt rather than equity. Sometimes there's government-backed grants and loans that are available. So I definitely advise founders to start there. And then beyond survival and perhaps small angel investing groups, you then start to look at more sophisticated investors who can see that you've got traction, you're beyond survival, you're probably operating in it upwards, definitely upwards of 7 figures at this stage. And at that stage, you can then start to look at other angel groups, other types of debt financing, particularly if you're profitable. And this is where I think profitability is really hard but key. That the days of huge valuations of consumer goods businesses and easy money are long gone. That does not happen anymore. You have to have a really solid plan and probably profitability nowadays to be able to raise a decent amount of funding. And then beyond that, you'll get into your Series A, perhaps looking at venture firms or private equity as you then start to scale up Series B through, say, even F.
Okay. And a lot of founders obviously aren't au fait with, this world. How do they approach this? And is this something you guys kind of help them with?
Yeah, this is a key area we help businesses with all the time, from the pitch deck to building a financial model. In my opinion, the financial model is just a really key, it's like a roadmap for your business. And even if it's really, really simple, every business should have one. it's important that, particularly in consumer goods businesses, that roadmap includes a balance sheet as well as a P&L, because like we've just been talking about with the working capital, you can only scale these businesses because they're working capital negative with an understanding of how much cash you're actually going to need to scale them. And we haven't even talked about companies moving into retail or wholesale. We just sort of talked today about direct to consumer, but they require even more cash if you're going to put down a lease deposit or potentially have like a retail fit out as well. So working with either, whether it's we actually have an accounting and bookkeeping company as well. We actually have a full team of finance professionals that can be tapped into on a fractional basis to do things like financial modeling. And the great thing is we see many, many companies. So it's easy for us to challenge perhaps your thinking. For example, I had a startup coming to me with a product margin of 60%. And in meeting one, I was just like, I'm actually just not even going to take this conversation any further because I know that in 12 months, your company won't be here. So go away, come back with a decent product margin or at least a path to it, and then we can have a conversation. And I know that's brutal for founders to hear, and sometimes they don't want to hear it, but that's the truth of operating in this industry.
I know we're maybe jumping about a bit, but could we just take a second to talk through maybe at the 6, 7, and 8 figure level, what kind of finance functions of yours should brands be kind of looking to take on? So starting from kind of nothing, what should they add on and in kind of what order and at what level?
Yeah, so we offer a fully fractional service. So throughout the 20 years I've been doing this, I've worked in businesses from over 100 million pounds in revenue through to literally startup companies. I was actually doing the bookkeep back in the day. I was doing the bookkeeping for my friend's business, and I've literally built the finance function from the ground up, from literally getting an account with zero. And I saw the need. It's a little bit like Groundhog Day kind of in my career, where these companies were needing the same service, but really on a fractional basis because different parts of the finance team bring different skills. So at the outset, a lot of the bookkeeping actually can be done yourself. So the key is just to getting the right tech stack and set up. If you get that out the gate, then actually you, in the very outset, you probably don't need a lot of bookkeeping support. I would focus your funds on actually making sure you have a scalable financial model and that you really know the metrics that you need to be scaling, because otherwise, or having a conversation with someone like myself, and there's lots of other people out there that can have those conversations, making sure you know your numbers and you've got a plan that is scalable and can work, and then having a good tech stack set up that can save you time. There's so much automation that can go on nowadays. You can actually keep your bookkeeping costs pretty low at the outset. And then moving on as you're growing probably 6 into 7 figures, we typically work with 7-figure companies unless they're sort of scaling super fast and we can see that they've got a really clear path to those 7 figures. They come to us where they need more advanced finance services, such as like planning, budgeting, speedy monthly financial reporting. Really great. Really, we're building at that stage a finance operational platform that can get them probably from 2 mil to 20, even $30 million in revenue, at which stage they may need an ERP. And at that point, we actually have companies we've worked with that will help hire in their finance team that will then take it from sort of an outsourced fractional team into transitioning into having more finance resource in the company. And then often we'll still offer perhaps the fractional CFO or FP&A, which is financial planning and analysis, on a fractional basis until they're ready then to hire that head, because the heads get really expensive at that stage and you've got to be at kind of critical mass before you can afford to hire those people full time.
Okay. So it's kind of do it yourself while you're figuring out, product market fit, then bring you guys in. And then, once we've got to that, multi 8 figure level, you'll help them kind of hire the team and they should bring it in house.
Yeah, but definitely having conversations in those early stages to make sure that you got a really solid tech stack and that you really, really understand the fundamentals of your business. And
So
some
which
businesses, I'm just working a couple of hours a month with the founder. Really, it's a check-in and just making sure that things and the numbers on track through to kind of more extensive kind of contracts where we're really kind of like the right hand people in terms of that finance function and that team. And I've got a team that I actually work with. So yeah.
No, that makes sense. I was going to ask, like, do you consult maybe on a lower scale those kind of early stage businesses? But it sounds like yeah, and they can kind of do the rest
Yeah,
of the job.
exactly. And I think the great thing about so the Stack has a sister company called the Finance Stack, and we collaborate to have a really great pool of resources that we can pull in on a fractional basis. So wherever possible, I will use that kind of cheaper resource who are highly experienced, incredibly bright and intelligent people to do the majority of the work, and I'll kind of oversee it and then have perhaps a monthly conversation with the founder. So a lot of that financial reporting, we have just a really standard set of processes. Each consumer goods company is broadly the same in terms of finance operations and processes. So it's looking at how we can bring them into kind of our platform, which is standardized, and then just allow the founder to focus on what they're good at and not having to worry about finance and how they should set up their finance operations, because we've got a plan for that.
Yeah, for sure. I want to shift gears slightly now, and I know a lot of the kind of marketing piece that we've talked on has been acquisition related. In terms of retention, how important is that, and when should brands start to kind of take retention marketing more seriously?
Day one, like for me, retention based marketing is it's like a leaky bucket. So people can be sending in traffic from Google, Facebook, where TV, radio, wherever it is, unless you've got some sort of, unless it's like a completely direct response, see the ad, purchase on day one. You need some sort of retention based marketing. And whether it's companies just doing it themselves out the gate in Klaviyo, just getting some form of email flows up and running is, if I was running a business, it's the first thing that I would do. And when I see companies that, for example, do the things that OHM does and invest in flows and retention, it's probably the highest ROI marketing spend that I see.
Slightly off topic, but how important do you think it is kind of focusing on getting repeat purchases and kind of returning traffic?
It depends. Depends on the business and the product. And this is one where it depends on the product roadmap as well and what the plan is. And the founder needs to have, I think, some sort of true north or direction out the gate in this sense. Some companies will be literally a one and done. I've worked with a business who do 90% of their revenue in a 6-week run up to Christmas, and it's a single purchase. And they've got a positive contribution margin. They're scaling their ad spend at scary levels over this 6-week period to companies that have a really solid repeat purchase rate, and they might want this product in blue, and then 3 months later they come and buy it in black because it's got a great fit, and then another 3 months later they come and buy it in gray. So the answer is it depends, but I think we've kind of talked previously, Jordan, a little bit about CAC and NCACs and new customer acquisition, understanding what the cost is to acquire a new customer versus product development and the time it takes to then reacquire that customer and bring them back in through retention-based marketing. As a founder, you need to start to really understand these things as you're scaling. But in terms of retention, it's really expensive nowadays to acquire new customers. And I think what I see across the industry is that it's cheaper to develop new products, offer them to the customers that you've got, than it is to try and scale a new customer acquisition all the time.
So in that NCAC metric, you're looking at retention costs, obviously, but also product development costs for other products. or no?
It's going to depend company for company. And I think this is where these conversations are really critical to saying what's going into that number. Because product dev costs, again, I think can be too often kind of ignored, particularly when you're like, oh, it's just payroll and it's my team. And suddenly you've got $100,000 year head that's just doing new product development and the sampling costs. So that's got to be, which can be seen really as an asset for a business. So, it could be that we need to invest 100K in product development, but this product's going to be in existence for 3 years. Having that conversation with the founder, with yourself, with the marketing team is critical to understanding what your strategy should be in terms of deploying your marketing budget.
Sure. Okay. And then kind of going back to talking about retention, is there any platforms that you say outside of email brands should look at? And I'm thinking here maybe, direct mail, SMS, loyalty programs, or anything like that.
Yeah, post-pilot for sure, which we've seen kind of just come up over the last, I don't know when Drew founded it, maybe 2 or 3 years. I mean, he's been in this industry forever. I think if there's any ecom founders out there today that want to follow someone on LinkedIn, I'd definitely recommend checking out Drew Sanoki. He writes some great content on basis of like retention marketing, and the companies that I'm working with actually are seeing really, really solid returns on the platform right now. It's great to have kind of a new channel to play with where you can be super creative, and it's really interesting. If a founder wants a 10-minute job today to just go and explore, go and run your customer list in Shopify. And this is one of the first things that I actually do for companies when I come in and start talking to them. I'm like, how many of those customers are actually on your email list? And typically the companies I work with are amazed, blown away when they see how many customers that they've had that aren't subscribed. And so I think things like Post-Pilot offer a huge opportunity for re-engaging with that customer base.
Okay.
And then, yeah.
No, were you going to say something else? Sorry.
No, go ahead, John.
I was just going to push on to the next question, which was about kind of restocks and pushing products to, pushing traffic, sorry, to products that aren't in stock or on sale. How can we make sure that kind of disconnect is avoided?
This one, I think, has to be my pet peeve in terms of finance and marketing agencies. The number of times I've been into a Google Ads account and I'll check it in. I always like to have like a poke around their digital marketing accounts. And I then look at the traffic and where it's going and say to the founder, hey, your agency is telling you you're getting a 5x ROAS. Well, do you realize that all that traffic is going to your sale page? And whilst 5x ROAS might work across your whole product collection, when you're driving all your traffic, so your ROAS look great to discounted product, actually that campaign is loss making. And I see this time and time and time again. And so that's where I think that having finance, which around the table, often we're the bad guys, right? We're telling people things that they don't want to hear. But telling them this and actually making sure that we really understand where our traffic is going. So that link between finance, like product strategy, and having the marketing team aligned around product strategy. Like, Jordan, I don't think you want to be setting up email campaigns and flows for a bunch of products that are going to run out of stock in 4 weeks. Like, that's such a poor investment in time. And often I know that you're different. I know that you guys understand this, but I see so many agencies setting up these campaigns to products with no idea of what the overall product strategy of the business is. And then that ties into finance and working capital. Hey, marketing agency is pushing these 5 products. We're going to run out of inventory. What's the payment terms? What's the factory doing, and what's the lead time to then restock those products? Those conversations should be happening on at least a monthly basis, and often they're not.
Yeah, there's a lot of Slack messages I see where it's, oh, this campaign went out to this product which is out of stock, but we haven't been told. And, the client has signed off on it 2 days before or whatever. And I think, yeah, it moves fast, right? And I think everyone just needs to be kept in the loop.
Yeah, totally. And it shouldn't ever get to the stage where this is coming through on Slack and time and effort has gone into that creativity. So that's where the demand plan kind of comes in, having, which is a really hard piece of work to do. And quite often we help companies out with it's, you should have like a product level demand plan to see what you're going to be buying. So that information can be cascaded to your agency, the creative done, and then those investment in assets put behind profitable, scalable products. There's a big difference between products that say have a 70% product margin that you can restock in say 4 weeks versus a product that is say a 50% product margin and takes you 6 months to get back in stock. They might all have a place in your collection, but everyone needs to understand what your product strategy is.
Okay.
Be
I
able
want
to
to shift.
compete.
I want to shift gears slightly now and talk about trends and challenges for the new year. So we are recording this at the beginning of January, and I just want to ask, what trends are you seeing in, finance and operations for ecom brands today?
Finance as a function is changing and it's going to change. I think the bookkeeper role 5 to 10 years out will be gone. AI agents are coming in to replace these roles, which is great for brands and founders because they should ultimately, we're not there yet in any way, shape, or form, but they should see their cost base when it comes to finance operations coming down. So the company, the work that we do is really getting companies on the best tech stack possible right now to automate as much as possible, but the human element is critical. We've just seen it with bench accounting, who got last minute acquired. I don't know if you're familiar with a company, Jordan, they're based in Vancouver, but they sort of overpromised a lot of automation and AI. And if you look at the customers, they're like, you know, so AI is coming, but that human element and that experience, I think, will remain for some time. The CFO role isn't just a numbers role, but it's, you end up being kind of coach, benchmarking, helping them out with strategy and planning. The trends I'm seeing is that consumer goods businesses now already have to be profitable or a very quick plan to profitability out the gate. So often I'm working with companies, really making sure they understand their overheads and that they have a really solid financial plan and forecast to operate against and that they understand it. So the key trends are within the industry embracing AI. And then secondly is companies having much better finance planning, monthly reporting against budget and being able to move at speed because it's not easy out there. The economy is challenging. Interest rates are still on the high end. So acquiring debt for these negative working capital companies is a challenge. And you really need to have a good solid foundation when it comes to your profitability to be able to scale.
Sure. And just touching on that point, and maybe it is a longer term trend. I had my brand, well, I started it around, 7 years ago. And I thought at the time, we weren't as profitable as I would have liked and certainly hoped, as each month went by. And I talked now to some of the founders that we work with. It's very different and it's getting, harder, it seems, to maintain profitability. Can you just talk to, why that shift is occurring and what founders can do to help mitigate some of that?
The trend I'm seeing is that customer acquisition costs are it's getting harder to acquire new customers and it's getting more expensive. So to get around that, I think you really do need to be embracing retention based marketing and having a proper product roadmap map and plan depending on what your unit mechanics and your P&L looks like, but having a plan to, hey, I've acquired all these new customers. Well, now what am I going to do with them? What's the plan for them? So definitely that new customer acquisition cost, like competition on platforms like Facebook and Google now is insane. And if you're a smaller company, you're less able to optimize your campaigns through AI because you just don't have the budget for the algorithm to learn at the speed. So you're always going to be more inefficient as a smaller company on that platform versus a larger company. I think there's still some sort of white space out there in terms of like creative TikTok community based marketing. And then as companies, like, I think it's not great when companies start a multi-channel approach out the gate. You're overpaying for your overheads because you haven't perhaps you're trying to be sort of master of all things, and that's incredibly difficult. But I think at some point in the strategy nowadays, it's really hard to be kind of a single platform brand or company or just D2C. I think you need to embrace retail at some point.
Interesting. Could I just get your thoughts on exiting and kind of how multiples and exits are and how they're kind of have changed over the past couple of years and thoughts going forward?
Yeah, I mean, this has become kind of quite the consumer goods story over the past like 3 or 4 years, right? There's been several public IPOs at significant valuations, like Allbirds, for example, who are now operating at 90% lower in terms of their market cap versus their original IPO, and they're still not profitable. Like, this is how hard this game is. Like, Allbirds was, I remember, a couple of years after they launched, there was this incredible sort of D2C story, and their branding was spot on, their storytelling was spot on, but they're still an unprofitable business. This is a really hard space to operate in, right? And so what was, I remember sort of going out raising finance in sort of 2015 through 2019, 2020, even at 5 to 7 times revenue multiples for high growth brands. Those days are over. I mean, if you're getting a 2 times revenue multiple right now, you're lucky. And as a smaller company, sub 10 million, 3 to 4 times adjusted EBITDA. So that sort of long-term vision of, hey, yeah, I'm going to be a consumer goods company making huge amounts of money and retiring, you have to really love it to want to do it and have to be operating the business at serious scale to be able to exit.
Okay. Next, I want to talk about fractional services and outsourcing. I know this is kind of what you do, and you've obviously been hugely successful. It feels like it's becoming kind of more popular. When should brands start to explore some of these options?
I think out the gate, like, you as the founder, you're going to have some things you're good at and some things you're not good at. And I think the more successful founders are the ones that figure out what they're good at and figure out what things that they need some help with. I always remember hearing Richard Branson talk at Virgin. He's just like, I've got no idea how to do all these things, but what I'm really good at is hiring great people. And that became his skill set, and really the success around the Virgin brands that they are. So I think it's hard. What is really hard, particularly on the marketing agency side, is I see a lot of agencies literally just charging 5K out the gate for these companies per month. And then having, perhaps, this is another one of sort of my pet peeves, is having a marketing agency that's 5K a month, and then they've got a ads budget of 5K a month. Like, it just doesn't make sense to me. Your ad budget needs to be probably 10x what your agency fee is, and you need to figure out how you get to that place really, really quickly. Otherwise, it's just highly inefficient. So I'm saying, I guess I'm contradicting myself here. And I think this comes back to how hard it is to scale, because it can be pretty messy and ugly in getting to your first $1 million. You've got to wear many hats, and you can't afford to hire in experts. So tapping into some fractional resource, getting to that critical mass at $1 to $2 million, really having that proof of concept, and then fully embedding a fractional team to take you probably to 10 to 20 mils when you can start to afford to bring some of those, particularly more senior resources in-house.
Okay. I want to talk now about risk management, and I know you brought up, some of this before with kind of supplier risk. Obviously, there's also, foreign exchange, all these kind of different problems that can arise if overlooked. How important is it, and yeah, what can brand owners be doing to kind of mitigate some of these?
Yeah, this is something I talk to companies about a lot, actually, and more so. One of the things that I like to talk to founders about is like, I see the business really as like an operating vehicle for them personally to grow their personal wealth. So detaching themselves from this vehicle that is their business. So working on the business as well as working in the business. And that includes addressing risk management. So you've talked about foreign exchange risk. I mean, look at the US dollar to CAD rate right now. We're at 143 today. That was 130. I wrote a LinkedIn post on it the other day. You can go check it out because I'm like, hey, if you're a Canadian company buying goods in US dollars, you've just lost a third of your profits right now because that's how much it's probably impacted your business. This is huge. You really need to think about your geographic strategy. Can you be selling to US customers to have, in this case, like a natural hedge against the weakening Canadian dollar? So thinking through FX risk is significant, perhaps less so if you're a US company buying in US dollars, selling to US customers. You don't have so much exposure. Obviously, you can tell from my accent, I'm British, growing up in the UK with pound against the euro, the Aussie dollar, the US dollar. We're used to dealing with multiple currencies, and it can have a significant impact on businesses. The other question I often ask founders is, what happens if you die? So, and you're laughing, Jordan, but this is true. Like, founders don't think through this inevitability. Well, there's one thing in life that is true is that we're all gonna die. And it's a risk to the business and the people that are then gonna take on that business after that event. So having proper life insurance, critical illness insurance in place as well. So if you're sick or some life-changing thing happens to you, can the business kind of continue to operate whilst you're off sick? Or if you die, is there enough funds in the business so that then the people that you pass that business on to can either sell it or continue to operate it? Because if you're not in the business, it's likely that that business would then achieve a significantly lower value than if you're in it. So addressing some of the, and supplier risk is huge. I mean, we've just seen it in Canada when the ports shut. We had the Canada Post strike. Having over dependence on one supplier and having risk in your business can hugely impact companies globally.
Drawing it, yeah, I know Canada as well as the UK, they've had a lot of risks like these cropping up right over the past few months. It's been tough.
Yeah, and when you've got a small company operating on really thin margins, you need some cash buffer in the bank to be able to absorb some of these things as they inevitably happen. And it's hard for founders that are literally operating on fumes when it comes to cash. So just as a benchmark to put it out over there, you really need to have 5 to 10% of your revenue as cash held in your business to really be able to operate with a little bit of headroom. And that's the absolute kind of minimum I would want to run a business on.
So just to clarify, because I think that's a good kind of metric or KPI, 5 to 10% of annual revenue should be in the bank account. Is that what you're saying?
Yeah. Yeah,
Okay.
because otherwise it's too challenging to navigate your age payables and
Yeah.
age receivables. Yeah. So on $1 million business, that's having at least 50K in the bank at any one time. And at 50K, that's you're managing cash probably daily, if not weekly. At 100K, you might be able to get away with managing it fortnightly.
Yeah. That's it's a hairy business, right? It's not for the faint-hearted. Okay. I want to, before, as we kind of come to the end of this, I want to talk about sales channels and the kind of thought process there. I have kind of mixed views on this, but could you just give maybe, super high level how, what advice you have for founders trying to figure out the right channels? And, here I'm thinking D2C, business to business, distributors, what channels, when, why, how, kind of, yeah, whatever your thoughts are on this.
Yeah, and I break D2C into two, which is eCom and retail, your own branded stores. I think most companies, the easiest way to start right now, and the barriers to entry are so low, which is kind of why competition has gone up so much. It's really easy to pop up a website, John, you could probably do it in a matter of hours, stick a product up there and get going. It's crazy easy nowadays. Each sales channel comes with different margins. So just to run through the classic margins, because these margins have been, since I've been involved in consumer goods over 20 years now, these margins haven't really kind of fundamentally changed too much. There was the whole like 2010 to 2015 where it's like, oh, it's cheaper to acquire customers on D2C. Well, it was until it wasn't. Actually, now it's just more about cash timing. So D2C margins typically 70% product margin, probably around 60% gross margin. Your wholesale B2B route will be operating within a 40 to 50% margin, and your distributor channels normally picked up from port. So that's where you kind of gain that efficiency, is that your distributor is picking up often from China, and they'll be operating at 30% margins. There's lots to think about in each channel, and you really need to understand how you're going to support the channels, because I see companies sort of going B2B, but they don't really have a solid plan as to how they're going to support that channel with marketing efforts and what the right budget is to put against that. Obviously, you need a much higher marketing budget to allocate to kind of per transaction to a D2C channel than you do to a B2B. But B2B isn't just a set it and kind of forget it. Those channels need supporting. And then pricing is the thing that becomes the huge issue. So you might be like, hey, I'm gonna sell these t-shirts for $100 on my website, and then suddenly Mr. B2B down the road is selling them for 80, and you got an issue, because then all the volume, particularly with the outset of Google Shopping, right? Everyone is running Google Shopping. So if you're then competing for real estate on Google Shopping against your customers, that's a tough place to be in. So having a really clear pricing and discounting policy embedded into your contracts is a way to at least help you navigate that.
I think this a lot, and I've tried to ask some brand owners this. How on earth do you manage the variability amongst these different models in one business? And is it like having separate kind of mini businesses within the main company? Or yeah, any kind of tips there?
It's really hard, because you actually have to be an kind of expert at all of them, and you need additional overhead and additional resource. So if you look at, for example, your demand planning with your B2B, it's wildly different to your D2C. You're collecting pre-orders. You've got to combine. I mean, thank goodness, like on Shopify, for example, now you can actually can take some of the legwork away, but often companies are really plugging the gap still with spreadsheets. And the inventory management tools out there, they say they forecast your inventory and help with demand planning, but they really don't. There still needs to be some sort of spreadsheet or tool kind of in between, unless you're literally selling, I don't know, whatever commodity on Amazon, then yes, maybe that can help with your restock. But otherwise, if you're like a kind of collection-based business, you need to be having something else. I've probably gone slightly off track with that question, Jordan. I can't remember where
No,
we
all good. I
started.
think
But my message is, it's like incredibly challenging, and you got to have different skill sets. Like you'll need a salesperson for your B2B business. You'll be needing to look at commissions, because that's typically the way it
yeah,
operates. And then your distributors, you've got to be careful about the markets you're going into and how your brand is being presented. And so having that support in terms of perhaps a brand book and assets that can support that
yeah,
market is important as well. It's really hard, and I think a lot of founders don't appreciate the costs that come with operating 2 or 3 different sales channels. If you just look at finance and accounting, if you're then invoicing B2B, you've got to collect cash. That's actually driving your accounting costs as well as like your financial reporting costs, because we're going to be wanting to report channel-based profitability, which is really important. But that comes with additional costs too.
for sure. I just remember when I had my business, we were D2C, and I did like one retail thing. I don't know what happened. I just lost money. And I was like, I'm never touching this channel again. I've just got too much going on the D2C side, and I'll just put it straight to bed. It's
Yeah,
just
and
not worth
we've
my
talked
mind space.
we've talked about risk, right, Jordan? Some customers go bust and don't pay,
Yeah.
and you actually need to build in your model the fact that that sale is only really a sale once you've got that cash. Again, commission-based structures, making sure that your commission is based on the cash collection and not the revenue.
Yeah, for sure. I just want to, before we end up, talk about kind of business stories. So you're obviously very close to the numbers and the truth for a lot of businesses. Do you have any kind of like favor or crazy stories that you've seen kind of from up close?
Yeah, I think my favorite one recently is this is where we kind of get onto the legal side of things, but a business, and actually I've seen this on several occasions, is that the founders need to split up. There needs to be effectively a founder divorce. And
Is this a romantic relationship that needs to get divorced?
no, no, this isn't. This is people that set the business up together, and for whatever reason, whether they have different opinions on strategy, um, life reasons, people, often you can't pay yourself much as a founder, and someone might just need to go and get a job. So at this point, my advice is to go and get a really good shareholders agreement from the outset. But I think one of my favorite stories is seeing a founder CEO go through this and have to really then not only go through that as a transaction and the buyout and et cetera, but then turn around the business. And seeing this founder do that over a 12-month period to what was a really, really solid Q4, I think is one of my favorite recent stories, because I saw them just go through the ringer and then come out the other side of it. And actually, we've talked about profitability today. In this case, the founder literally looked at every penny that was going through their P&L to turn this business around. And it's amazing once you start examining your costs at that level, what you can really pull out and do with the business.
Yeah.
I've been reading the Netflix book recently. It's pretty cool. If you haven't read it, the story of how they grow the business. And what sort of stuck with me was them at one stage having to let go of sort of 10-20% of their workforce, but actually they just became more efficient and better because they had a smaller, higher performing team.
Yeah. What is that? Sorry, is that a documentary or?
No, there's a book, I can't remember what it's called. It's about the story of Netflix as a business and how it scaled, but it's
I
been
see.
kind of fun reading that one.
And can you share a specific example? I think when we talked before, you said something about a 5-inch short that highlights how kind of different approaches work in different markets.
Yeah, this is really, I think I got two good stories around this. This was really early in my career, a UK company, and launched, it was in the sort of sportswear market, and we launched a 5-inch short into the US market. Literally just got, I think we were probably like 10 years ahead of our time, and just sort of got laughed off the streets because everyone looked at the brand and they were like, who would wear that? Like, no one over here. And that, we'd invested quite a lot in terms of going to the US, doing some marketing, getting going, and then this realization that they just didn't wear a 5-inch short for guys at the time.
I
It's
was going
quite
to say
funny.
now it's trendy, right?
Yeah, now it's trendy, right? We're just ahead of our time. But the other kind of interesting one, I've done a lot in the ski industry and outdoor industry. The classic is the bright colors in Europe. So in Europe, we love like a fluorescent ski jacket. And in the US market, that just does not fly in any way, shape, or form. So as you're doing your kind of product roadmap and strategy, it really needs thinking through, because buying the fabric is incredibly expensive, and thinking about what's going to sell in what market is critical, because it isn't the same globally, and you can't just drop a product into another country and
Yeah.
expect it to scale or sell in the same way. It just doesn't.
Yeah, it's not just copy and paste, right? I think there's cultural differences for sure. Okay. Well, look, as we finish off, Helen, if you could give one piece of financial advice to brand owners or founders, what would it be?
To plan. Really understand your numbers and come up with a plan before you go out buying product, spending money. Make sure you understand your financial model and plan, because it can be really expensive going out, spending your kind of hard-earned
Yeah.
savings and not really understanding the mechanics of how consumer goods business works.
Yeah, for sure. Well, look, thank you so much for coming on the podcast today. It's been great having you and a lot of kind of useful info for people. Two final questions to end off. First is, yeah, what kind of size businesses, sectors do you work with, and where can people find out more about you guys and get in contact?
So we work with businesses typically that have sort of exited that survival stage and are really needing those higher level finance resources kind of coming into that team. So typically businesses $2 to $3 million in revenue and scaling. I think my business partner is Brad Williams. We both have a decent amount of experience in terms of raising capital and high growth companies. So we've had a lot of companies kind of in that space coming to us for those reasons and that expertise. And we invest a lot of our time in terms of that sort of planning and reporting piece, which getting those foundations of your finance operations in place is critical to scaling from $2-3 million in revenue, up to 8 figures and beyond. So yeah, I've got a website, which is the cpstack.com, and our sister company for kind of non-consumer goods businesses is the financestack.com. Yeah, come and say hi. I'm over on LinkedIn. I'm happy to jump on a call with really anyone for 30 minutes. So even if you're a startup founder and you just want to reach out and say, hey, I've got this product idea. What are, key metrics or numbers that I should be looking at? I'm happy to jump on a call and
Gonna hopefully
help you out.
not pour cold water over it straight away, just based on the
No, that didn't go down very well the first time I did it. But I think, people will probably typically thank me at some point
True.
later rather than spending their hard-earned cash on a business that just isn't going to work out the gate. So yeah, I try not to hold back too much. Although being British, I try and be as polite as I can.
Deliver the horrible message nicely is, yeah, always the way to go, right?
Watching a founder kind of learn to survive and then thrive is just fascinating. It's a really, really emotional journey. And, I see part of my role is kind of supporting that sometimes. And I think those stories are sort of as well as the product stories, and like, my favorite thing about doing what I do, that I am kind of privileged to work with these people that have this vision and are kind of grinding it out there and, being true entrepreneurs.
For sure. I think one of the things for me, and this is slightly off topic, but like running a business forced me to personally develop and fix a lot of the problems that I had in other aspects of my life, because you can't, well, one, you need to keep elevating to grow the business, but two, you can't be fucking around with some of this stuff, right?
Yeah, can you give me an example of that, Jordan? What have you personally changed?
No, I think just, yeah, in terms of like professional development, like running an agency, like having to learn all the skills and wear the hats, like you said, right? I've never sold business to business packages before. I had to learn that. And I think, yeah, like that applies to basically every area of the business, because you have to wear that hat right at the start before you can give it to someone else.
And those are the founders that I see scaling more often, are the ones that are actually open and receptive to knowing what they don't know, because there's always the
Everything.
that we don't, right? But working with experts, I mean, you like me, we've both seen, tens, hundreds of these businesses, and we know what works and what doesn't work. The founder often only sees one business or two businesses. So tapping into people that see multiple businesses, see what works, what doesn't work, I think, and having the humility to do so, the founders that have that humility to say, I'm not an expert in everything, are the ones that scale, that I see scaling the fastest.
Very true. Yeah, for sure. Well, look, Helen, I know we are over time, so thank you so much for coming on today. I've learned a lot, and yeah, I think there's, like I said, a lot of useful info for the listeners as well. So thank you.
All right, thanks for your time, Jordan. Thanks for setting this up.
Cheers. Bye.